Greetings and welcome to another episode of AM Trading. The ability to analyze market structures is a critical skill for both novice and experienced traders. It allows us to identify current trends, potential reversal points, and overall market conditions. In this video, we will provide a comprehensive guide on how to read charts like a professional trader. Our tutorial will cover both basic and advanced ICT concepts that will teach you how to read market structures and accurately identify market direction. If you find this topic intriguing, we encourage you to show your support by smashing the like button and subscribing to our channel. So let's get started, but before we do, let's define what the market is. In discussions of market structure, we analyze swing highs and lows, price movements, and past areas of market reaction. These elements constitute the framework of market movements. To illustrate the basic concepts of ICT market structure, let's consider the ideal uptrend. In this scenario, the market continually establishes higher highs and higher lows. A break of structure occurs when the market surpasses a previous high, indicating a bullish trend, or when the market falls below a previous low, indicating a possible change in direction. It's important to note that a break of structure is still considered valid, even if the market wicks above the higher high in the demand zone that was created, will still be a valid trading opportunity. However, to confirm a change of character, candlestick needs to break and close below the higher low. It is worth noting that price movements can sometimes be less predictable. In this regard, let's consider an important question. Which of these breaks can be deemed as valid and indicative of a change of character? To identify valid changes of character, we must first identify the swing lows. In the bullish scenario, the lowest point between two consecutive highs is the swing low. These are our two consecutive highs, and the lowest point between these two highs will be identified as our swing low. As long as the price remains above this level, the market is considered bullish, and we should only look for buying opportunities. Here you can see another break of structure, so the lowest point between these two consecutive highs will be our swing low. We can identify it here as well. Now here's another question. When can we assert with confidence that a reversal in trend will occur due to a change of character? To confidently predict a change of character that will reverse the trend, we must understand the fractal nature of the market. In an uptrend, we'll see a series of impulsive and corrective moves that create new higher highs and higher lows. In the process of analyzing the market at lower time frames, it is observable that the impulsive wave of the higher time frame is made up of impulsive and corrective movements that adhere to the lower time frame in the ideal situation. However, in an imperfect scenario, the price may produce false breakouts prior to ascending to create a higher high and sustain the trend. When traders see this breakout, they think the price will reverse and they go short on the supply zone and then get stopped out. To avoid such situations, we should look for trade areas where the lower and higher time frames are in the same direction. By doing this, we'll be able to go with the dominant trend and make more informed trading decisions. Let us take a look at the real-life chart example. On the 1-minute chart, we can see all the impulsive and corrective moves. But if we zoom out on the 5 minutes, we can see clearer impulsive and corrective movements. So by confirming that the direction of the 1-minute chart aligns with the 5-minute chart, there is a higher likelihood that the price will continue in that direction. These are just the basics of market structure. Let's move on to the advanced phase. Before we proceed, if you found this video informative and valuable, we would greatly appreciate it if you could give us a thumbs up and subscribe to our channel. Your support will enable us to create more content like this. Now, when discussing the market structure of ICT concepts, it is important to consider who is in control: supply or demand. The key point to note is that a valid supply and demand zone must meet 3 criteria. Mitigating or breaking these valid levels allows for the identification of market direction. The first criterion for a valid zone is that it must have an imbalance. Imbalance refers to a lack of proportion between buyers and sellers, resulting in a massive move in the market. The second feature of a valid zone is that it must break the structure or change the character. The third feature is that it must be unmitigated. Supply and demand zones are one-time use, so zones that have been mitigated before are no longer considered valid for us. If a zone lacks any of these criteria, it will not be considered a valid supply or demand. Now I will show you some of the common ICT market structure patterns and how to approach them. The first pattern is called the market flip. This pattern occurs at the end of trends when they get exhausted, resulting in a direction change. We have a valid demand zone with a break of structure and imbalance. The market mitigates this level but fails to create a higher high, showing momentum loss. This eventually leads to a change of character and leaves behind a perfect trading opportunity. Thus, we go short once the price taps into the supply zone, and our target will be the next unmitigated demand level. Let us examine the situation on the live chart. Initially, the market was experiencing an evident uptrend until a demand zone was formed, resulting in an imbalance and a breakdown of structure. Despite efforts to mitigate this level, the market failed to establish a new higher high and subsequently breached the preceding higher low. Thus, a valid change of character occurred, leaving an optimal supply zone for us to enter. As soon as the price reaches this level, we may initiate a short position and set our take profit at an unmitigated demand zone. Next up, liquidity grab pattern. This pattern occurs when most traders take a fake out as a change of character, and the market continues to push in the same direction when it reaches a valid supply or demand zone. Here, we have a valid break of structure but no imbalance. However, to the left of the chart, we have a perfect unmitigated demand zone with a break of structure and imbalance. If the market breaks through this level, we would not take it as a change of character and instead look for buying opportunities in the demand zone. Let's turn our attention to the live chart. We can observe a consistent pattern of higher highs and higher lows. Although the demand level broke the structure to the upside, it did not leave any imbalances. Hence, it cannot be considered a valid demand zone. By examining the chart to the left, we can identify imbalances that have created an extreme demand level. Consequently, this change of character is not valid to us and is perceived as a liquidity grab. At this point, we can place our buy order at the top of the order block and set the stop loss just below the order block. Additionally, our target profit should be placed at the next level of market structure. It is crucial to acknowledge that these particular setups offer a favorable risk-to-reward ratio. Even if the win rates are below 50%, profitability can still be attained in the long run. Nevertheless, it is strongly advised to secure some profits in case the trade turns out to be profitable by utilizing a trailing stop-loss strategy. Thank you for watching this comprehensive guide on how to read charts like a professional trader. We hope you found the tutorial informative and valuable. Understanding market structures is essential for any trader, and we have covered both basic and advanced concepts of ICT to help you read market structures and identify market direction accurately. Remember that the market is always changing, and it is crucial to keep learning and practicing to improve your trading skills continually. We encourage you to show your support by smashing the like button and subscribing to our channel for more content like this. Keep trading and stay tuned for more exciting episodes of AM Trading.